We're just waiting for Redmond, the key contributor.
Okay, in the interest of time, maybe I'll just kick off, and he can join in a few minutes. So, good morning from rainy Singapore today. Welcome to Saxo's weekly market outlook call. I'm Charu. I'm the market strategist with Saxo Markets Singapore. So, where do we start today? I guess there's only one answer to that question, and that's Jackson Hole. So what happened was a crisp 8-minute speech from Powell, and the markets finally realized that we are in an aggressive rate hike cycle and macro conditions remain weak. This is a reaffirmation of Saxo's base case that inflation will be higher for longer, and taking comfort from the softer July print is premature. We did have another soft inflation print, that was the PCE on Friday in the US, which was below headlines both on the headline, which was below expectations both on the headline and the core. But again, key contributor to that remains the lower gasoline prices, and we still continue to see upside pressures to inflation. The Fed has reaffirmed that repeatedly now. So there will be more rate hikes, and we've been saying that before. The bond market hasn't really reacted a lot to what Powell said, even though we had a run higher in the US dollar and a slide in equities. The weaker Asia Open today also suggests that there is more pain coming. Because today as markets open across the globe, we will see Friday's speech being digested. I think the notion that a Fed pivot is coming has been put to rest for now. So we could see some unwinding of positions this week, and possibly lower lows are in sight for equities. So buckle up. Not to say there wouldn't be more rallies, but the downtrend will likely be more pronounced for now. And to be fair, there is still considerable uncertainty on the magnitude of the September rate hike. That does mean that the focus is squarely on the jobs report that is due this week and the August CPI report that will come out on the 13th of September. So the payrolls this week, I think key to consider that we did see a strong outperformance in July, and expectations for August are still pretty upbeat again, with the consensus at 300K for now. My sense is that there could be some moderation because we are drawing towards the close of the driving season and the holiday season in the US. But again, it will be more important to watch the unemployment rate and the wage growth. Plus, the message has to be extremely consistent from the jobs report and the CPI report to really get to a 75 basis points rate hike on September 21. Else, what we will most likely get is a 50 basis points with a hawkish dot plot and a hawkish commentary with that. And I think the key question now should be really shifting away from the magnitude of rate hikes to how high the terminal rates go and how long we're going to hold them there. So I think that's more important. And let's not forget the quantitative tightening from the Fed also gets to its full pace in September. So while markets continue to digest these facts for now, I think we will only get greater clarity after the September meeting and possibly more downside in equities from there. Anyway, let's switch gears now to another pertinent issue, and which is the energy crisis. Things do seem to be getting worse in Europe. We had a week of gains in natural gas prices and a jump higher in power prices across most of the countries in Europe. This is likely to mean some pain for Asia's energy importers too. We did write a piece last week on LNG importers, Japan, China, and South Korea, and how they are exposed to this energy crisis situation, and the potential for them to consider nuclear energy. Japan did actually make some progress in that last week. Europe has been slower, but our sense is that the future would mean a broad-based supply of energy rather than dependence on one or two sources. So we will see more countries, especially Germany, taking that path because, of course, it is the most exposed in the Russia gas situation. So this week, we will likely see more volatility because the Nord Stream pipeline goes into maintenance again, which means there could be potentially more spikes in natural gas prices. The gas to fuel switch has also supported the crude oil market last week, and that could extend further as well this week. But there are also reports of production cuts in crude oil, and that could bring the next leg higher in crude oil prices. We have the OPEC Plus meeting scheduled for September 5th. That is the next Monday. So keep that on your radar as well. Elsewhere as well, we've seen strong gains in commodities, in grains because of the weather worries, and also in metals because of China's support measures. So overall, a pretty steady week for commodities last week. I think one last point from me about the ECB chatter of a 75 basis points rate hike for the September meeting. We do get European CPIs this week. I think that will again be key for the direction in the euro, along with, of course, the Nord Stream situation that we just discussed. If we do see supplies on Nord Stream getting ramped up to 30% of capacity, as has been hinted from the current 20%, we could see a big drop in natural gas prices and a rollback in ECB expectations. That is a tail risk that we are seeing. Anyway, the dollar story looks strong for this week following Jackson Hole, and that we are in the month end as well. Watch the yen again this week. That would likely see some pressure. So yeah, brace for that as well. And I'll stop here. Jess, Redmond, over to you guys.
Redmond, pardon me, I believe you're on mute.
Or you need to switch your microphone settings. Jessica, you want to start first?
Yeah, nice one. Good idea. So I'll just jump in until Redmond sorts out his headset. So a couple of key things, ladies and gentlemen, to watch this week. So the first one is key Australian economic data will be released following China's manufacturing activity. So China's manufacturing activity is key to watch for commodity investors and also Australian investors alike, because we'll get key clues as to how demand is picking up in some of those key commodities that are iron ore, copper, nickel, and coal. And of course, they're essential to Chinese manufacturing. But then after that data is released later this week, investors will then quickly move their attention to August's Australian manufacturing indicators. And we do have to remember Australia is not a manufacturing economy, given services contribute 70% to Australian GDP, very similar to the US, where 70% of their GDP comes from services. So why on earth is Jessica talking about watching manufacturing data on Wednesday, Thursday? Well, we do have to remember that Australia is home to many large manufacturers. And who are they? Well, in the energy sector, we've got Woodside, Caltex, and Viva Energy. We also have a global packaging company that will be closely watched called Amcor. And then, of course, the world's largest vaccine maker, CSL. And then moving along to other large manufacturers, we do have BHP, Rio Tinto, and Fortescue Metals. So what are we saying here? We're basically saying watch the key manufacturing data. If it comes out stronger than expected, what is expected? A reading of 51. If the reading is above 51, then you'll likely see a pickup in buying in some of those key manufacturers that we've just mentioned. That being said, we do have to remember that manufacturing data is slowing down globally, and this is because of high interest rates, higher wages, and we are also seeing a lack of resources. So it's harder to get people on the ground. And this has been alluded to in earnings results that have come out. So we'll be watching to see if manufacturing slows for the second consecutive month. Also pivoting to locally today, what to watch. So Australian retail trade data, this is the second point that I wanted to mention, is expected to rise to another brand new record high. And why we're talking about retail trade data, it's out in about 20 minutes. Why is it important? Because you can take away from it the key shifts in spending. And we're seeing a rise in dining out, secondly, winter clothing spree. And both of these things are fueling retail trade, and it's surged to its highest level on record, $34 billion. So when the data comes out in about 20 minutes or so, we could likely see a rise of 0.3%. If spending is higher than that, you'll likely see a pickup in consumer spending stocks. That being said, the Aussie share market is trading lower today following the hawkish speak from the Federal Reserve. The last thing, the third and final thing that I wanted to touch on today is results just came out from the fourth largest iron ore producer in the world, Fortescue Metals. So Fortescue came out producing their second highest profit on record. Their results actually saw their shares, so Fortescue Metals shares popped up above their 200-day moving average. And ladies and gentlemen, we know what happens when a stock or any key index moves above a 200-day average. It signifies that there's room for the upside in terms of a technical perspective. That being said, we did see the stock move above its 200-day moving average, but it's still holding above that despite jumping about 4%. It's now about 1% lower. So what's next is key. So Fortescue Metals has guided that it's going to continue to produce a record amount of iron ore. They exported a record amount of iron ore. Profit is 40% lower. 40% lower because the iron ore price is down 50%. Going forward, the company said that they're going to ramp up their focus on green metals, and I think that's why shareholders are quite bullish. And this is also supporting the move of Fortescue Metals, as well as BHP and Rio Tinto's move to the upside. We know that there's also stimulus talks in China, potential infrastructure stimulus hopes, and that is supporting all of these big heavyweights moving up 20% up off their lows. All in all, we are possibly seeing a short-term pullback, but we do see higher highs for these iron ore and mining heavyweights. Over to you, Redmond.
Hi, morning everyone. And it's not only the Powell has spoken rather hawkish, and which sent the market troubling, and also in the across the pond in Europe, the ECB, also some of the policy makers also brought the discussion of maybe a 75 basis point rate hike, at the September meetings into discussion. So to the table. So it's overall, and you see selling in the that is selling a lot in the equity markets, of course, in the US, and that is actually add to, of course, the damage to the decline we have seen for the whole week. And also there has been actually during the week we have seen commentaries from some of those managements of retailers. They're talking about mentioning to a glut of inventory and plans to cut prices, and all those already set a rather bearish tone. And then is basically the comment from Powell just kept a losing week, and with more reason to sell. And in the treasury market, in the US yield, and actually on Friday, interesting, you see 2-year yield jump, and that is expected, and but not jump a lot, but just 3 basis points to 337. But today in Asian time, it jumped more to now 343. And interesting is the long-term yield actually came down on Friday, and so the curve flattened, and then actually twist. So the 10-year yield not so much change, but after the year the yield decline, and short-term yield rises. So basically, it's a betting on more hawkish, more rate hike in the near term, and then it's increase the chance of a recession in the U.S. And especially Powell said, he's okay with some pains to the economy and employment, if that has to be the case, in order to bring inflation under control. And in Hong Kong and China, and I mean, Hong Kong, not starting from last Thursday, we have a strong rally, and because of the chatters about a deal on the audit work paper between the U.S. and China, and that the deal was actually announced on Friday after Hong Kong market closed, so for the whole week, Hang Seng was up 2% and outperformed the other market, and that also has impressive bounce from a 2-month losing streak. But because of what happened in the U.S. overnight, and the Nasdaq Golden Dragon already came down, gave up most of the gain, and then it's actually, I mean, it's basically is digesting the good news from that deal already from the U.S. and China. And one thing to note that is in the announcement and the Q&A, there's some differences, different emphasis between the U.S. regulator and the Chinese regulator. And the U.S. regulator is more saying that, okay, we got a complete concession from China, and that of course remains to be seen whether that can be put into practice. But from China's side, they emphasize the principle of reciprocity, and also they emphasize that actually they will be informed in advance, and also they will be consulted, they will be coordinated in all those kind of transfer of audit work papers and inspection. So that really to see how that is going to be implemented. And then is Meituan deliver a solid second quarter result, and actually turned up with a profit in the second quarter, while the market is a 2.1 billion RMB adjusted net profit in the second quarter, and then is that that was actually the analyst consensus was expecting a loss of over 2 billion. So that is a bit consensus very nicely, and the gain is actually across a major segments of the business, and so revenue up 16% year on year, and also the management mentioned that is the improvement actually the growth actually continue in July. And all the volume growth in July is in the mid-teen, and in the month today in August is almost about 20% growth in order volume in the food delivery business. So that is a solid result. And lastly, and I think overall as well, and China is the important data coming out this week will be the PMI and the manufacturing PMIs, and the official one, and the market expecting it to continue to stay below 50, remain in contractionary territory, and even though that maybe just edge up a little bit to 49.3, but still below 50. And Caixin is expected to come down towards more the 50 threshold, and will come down to 50.1 from last month 15.4, and then is that the key thing to note is really the heat wave, and that actually is a cause, and the drought and the heat wave actually cause electricity curbs, and in Sichuan and Chongqing, that is going to hurt manufacturing quite a bit, because Sichuan account for over 4% of China's industrial production, and Chongqing account for over 2%. I think that's it for me. Any other thing from Charu and Jessica?
I think that's pretty much all
Okay,
from us today.
wonderful.
Yeah, I think just let your RMs know if you want to be added to the Strats email distribution list. We do publish a daily note in the mornings, Asia mornings every day, and we do have a week ahead note coming out today as well, which is called the Saxo Spotlight, which will include a recording of this call as well in case you want to get back to it. And that's it from us today. Happy trading week. Stay safe.
Thank
Bye,
you.
everyone.
Bye-bye.